$400. That is the number. Not $10,000, not a funded account, not a prop firm challenge with a clean dashboard and a risk manager watching your drawdown. $400. Deposited on a Tuesday night after watching 3 YouTube videos and feeling, for the first time in your life, like you understood something that most people did not. You were wrong, but that specific wrongness is where everything starts. And the distance between that $400 and $33 million is not a distance measured in money. It is measured in versions of yourself that had to die before the next one could function. This is what that journey actually looks like, not the highlight reel. The full map, level 1, the entry, $400. You deposit $400 and immediately do the math in the wrong direction. Not, what is the maximum I can lose? But, how quickly can I multiply this? You open your first trade on EUR/USD because that is the pair everyone mentions. You do not know why EUR/USD. You just know that it is the one with the tight spread and the high volume. And someone in a comment section said, it was good for beginners. Your position size is too large. You know this vaguely, but the potential profit on the right side of the screen is larger than the potential loss. And you are focused on the right side. The trade goes against you immediately. You hold it because it will come back. Because you saw a video where someone explained support levels, and this feels like support. It does not come back. You close it manually at a loss you did not plan for. You open another trade in the opposite direction because now you know which way the price is going. The price does not go that way. By Friday, $400 is $210. You reload, not because you have a plan, because you cannot end your trading career at $210. That would mean something about you that you are not willing to accept. This is level 1, not the deposit, the emotion. You are not trading the market. You are trading your own fear of being wrong. The market is just the surface you are using to argue with yourself. The account will blow, maybe twice, maybe 3 times. The number changes. The behavior does not until the behavior changes first. The first rule, the market does not know you exist. Your emotions do, and until you understand which one is running your trades, you are not a trader. You are a person with a funded gambling problem and a charting interface. Level 2, the awakening. $1,000. You come back, not everyone does. The ones who come back are not necessarily smarter. They are more stubborn, which at this level is the same thing. You reload with $1,000 and something is different this time. Not your strategy, your posture. You slow down. You start watching price move without touching it. You draw levels. You learn the phrase risk to reward ratio. And for the first time, it does not sound like finance terminology. It sounds like a survival rule. You start understanding that a 40% win rate with a 3-to-1 reward to risk can be profitable. That the math of trading is almost the inverse of what you assumed when you deposited $400. You are not trying to be right. You are trying to be paid correctly when you are right. This is the shift from gambling to learning. It does not feel dramatic. It feels like sitting still for the first time, like finally stopping the noise long enough to hear something real. Your account does not grow at level 2. That is not the point of level 2. The point is to stop bleeding. The point is to understand that surviving is not losing. Surviving is the curriculum. The second rule, winning trades do not make you a trader. Surviving long enough to understand what you are doing makes you a trader. The market charges tuition. Level 2 is the first semester you actually attend. Level 3, the system builder, $5,000. You stop strategy hopping. This is harder than it sounds. Strategy hopping is comfortable because every new strategy carries the possibility that this one is the right one. Committing to a single setup means accepting that you might be wrong about it for weeks before you know. Most people cannot tolerate that uncertainty. They switch before the data is clear. They spend 3 years testing 17 systems and building mastery in none. You stop. You pick one setup, a specific structure on a specific time frame with specific entry criteria and specific exit rules. You write it down, you print it, you trade it identically every time. You open a journal, not because a mentor told you to, because you started noticing that you could not remember why you entered trades 3 weeks ago, and that felt like a problem. The journal is not motivation. The journal is data. Every entry, every exit, every emotional state noted without judgment. Losses still happen, but they are controlled losses now. Planned losses. A planned loss is not a failure. It is the cost of operating a system that you trust over time. You stop taking losses personally. You start taking them statistically. The account grows slowly. The growth is almost beside the point. Something larger is growing. A relationship with risk that is not emotional. A framework for decision-making that does not bend to what the price is doing in the last 15 minutes. The third rule, you do not need to win every trade. You need a system with positive expectancy and the discipline to execute it without modification. The trader who executes consistently beats the trader who is right more often every time. Level 4, the consistency phase. $20,000. The month ends and you are profitable. Not spectacularly. Not by a number that changes your life, but consistently. The same way the second month ends profitable, and the third. You risk 1 to 2% per trade. This seems small until you understand that 1 to 2% of a compounding account is not small over time. It is the mechanism by which everything else becomes possible. You stop chasing trades that do not meet your criteria. The FOMO is still there. You feel it every time a clean move happens without you, but you let it go because the system told you not to take that trade, and the system is the only thing that separates you from level 1. Here is the danger at level 4. It is not failure, it is success. Consistent profitability produces confidence. Confidence at the right level is useful. Confidence at level 4 before it has been tested at higher capital is overconfidence in clothing that fits wrong. You start feeling like you have figured it out. You have not figured it out. You have figured out how to execute your system on $20,000 in normal market conditions. That is real, and it matters. It is not the same as figuring out trading. The market will remind you of this. If you listen when it does, you advance. If you argue, you go back. The fourth rule, consistency is not the destination. Consistency is the minimum requirement for the next level. The trader who mistakes consistency for mastery spends a long time at $20,000, wondering why the account stopped growing. Level 5, the scale up, $100,000. Something changes when the numbers get larger, not the strategy, not the setup, the internal experience of loss. A 1% drawdown on $20,000 is $200. A 1% drawdown on $100,000 is $1,000. The math is identical. The emotional weight is not. Not yet. Not until you have been here long enough for the numbers to become percentages again, rather than dollar amounts. This is the mindset shift of level 5. You stop seeing trades in money. You start seeing them in percentages. A 3% gain is a 3% gain whether the account is $100,000 or $1 million. The behavior required to capture it is identical. The only thing that changes is the number attached to it, and the number is not the metric you manage. The percentage is. Funded accounts and prop firms enter the picture. Capital that is not yours, but that responds to your system exactly the way yours does. Multiple accounts running the same setup simultaneously. The compounding mechanism begins to make itself visible in the numbers. The curve starts to look different than it did at $20,000. You are no longer trying to make money. You are managing a system that makes money when you execute correctly and preserve capital when you do not. The distinction sounds small. It is not small. The fifth rule. The trader who thinks in money has a ceiling equal to their emotional tolerance for loss. The trader who thinks in percentages has no ceiling. Percentages are portable. They scale. Money is a story you tell yourself about the number. Percentages are the actual work. Level 6. The operator. $1 million. Trading becomes boring, not slow, not unprofitable. Boring. You have done this long enough that the setup either appears or it does not. If it appears, you take it the same way you took the last one. If it does not appear, you close the platform and do something else. There is no excitement. There is no anxiety. There are entries and exits and records kept without ceremony. You take fewer trades than you did at level 1. Significantly fewer. The trades you take are high quality. The setup is clean. The risk is defined. The execution is mechanical. Most of your time is not spent trading. It is spent waiting, and not impatient waiting, productive waiting. The patience of someone who has seen enough market structure to know that the next setup will appear, that there is no urgency, that forcing a trade is the only way to damage what has been built. The truth of level 6 is this. You are no longer a trader in the way you imagined it at level 1. You are a risk manager who happens to use the Forex market as the vehicle. The skill that matters most is not reading price action. It is protecting the capital. Because the capital, managed correctly, does the work. You are the guardian of the process, not the driver of the outcome. The sixth rule: the difference between a trader and an operator is the relationship to boredom. A trader needs action to feel productive. An operator understands that inaction, chosen correctly, is the most disciplined and profitable decision available. Level 7. The Empire. $33 million. Forex is one line on a spreadsheet, not the only line, not even the largest line. One of several income streams contributing to a diversified capital structure that includes real assets, business equity, market positions, and systems that were built and now run with minimal oversight. Trading is the skill that created the initial capital. The capital is now deployed in a way that does not depend on any single market, any single instrument, any single decision. You look back at the $400 deposit on the Tuesday night with the YouTube video playing. You do not feel nostalgia. You feel the specific clarity of someone who can now see the full map. The $400 was not the start of a trading career. It was the start of an education in risk, in psychology, in the relationship between discipline and outcome that took years to build and could not have been shortcut at any stage. Every level required the one before it. The blown accounts at level 1 created the posture of level 2. The system discipline of level 3 created the consistency of level 4. The percentage thinking of level 5 created the capital base of level 6. The boring precision of level 6 created the diversified architecture of level 7. You were never chasing money. You are building the version of yourself capable of managing it. The market does not give you $33 million. The market filters for the person who can receive it without losing it. Most people fail the filter at level 1 and do not return. Some make it to level 2 and decide the curriculum is too expensive. A smaller number build systems at level 3. Fewer still find consistency. Almost none make it to the operator level. The ones who do are not exceptional traders. They are exceptionally disciplined humans who happen to use trading as the instrument. The instrument was never the point. The control was. Everyone wants the $33 million. Almost nobody survives level 1.